As you know, we really look at companies from the bottom up, but if I were looking at the top down, I would be looking at what's going to happen with President Trump's group coming in and how they transfer everything they want to do into what I call real life. Therein lies the problem, because there's certain ways you could do that that might not upset the economy and the GDP so much, and then there's certain ways you can do it that would be more negative. And, you know, you hope that they can figure out what they need to do. If they're going to do that, yes, but there's ways that you can do things where it gets really ahead of itself and causes sometimes short-term damage that you didn't expect. Similar to what happened with Reagan when he came in, and from the day he was basically inaugurated, we had a 19-month bear market. So you have to be careful. You know, you have to think this time the man is going to have a lot of changes take place rapidly, because he knows what he's doing now. He's got all these people he's going to put in place. So I assume there'll be a lot of changes in a hurry. I guess that's the reason why we look at individual companies, because since I can't figure that out, what a good buy is, but I can't figure out necessarily what's going to happen in terms of where we go politically in the country. I still think, you know, the commodity sector, really not only during this term, but during the next 10 years, will come alive again. It's sort of been hit or miss a little bit in 24, but I suspect that natural gas, oil, you know, to a certain degree, the metals, they'll move forward and get more traction than we've had. I think people understand that a lot of the metals that we need, particularly precious metals, that sort of thing, we don't have enough of those, and we're going to see more of that. I think that's the way things will go. We thought all along that inflation would now go to another level as opposed to where it's been. I mean, that period from really 2009 until 2022 was a very abnormal period. If you look back at the history of money, that's never happened. It only happened because of the way they did things, really. Referring to where we were in terms of really, really low inflation. And it was one of those things where that was going to create some problems down the road. But if you look at the only thing you can use really is CPI or PPI, but that should be running now on normal, 3 to 4.5, or maybe 3 to 5. It's going to go back like it was. If you look at that period going all the way back to like early 1960s, you know, the end up to 90, you had a period there where the average was about 4 points or 4.25. And I think we'll go back to that. And if you go back to that, then, you know, inflation is going to be a factor here. Maybe not in the short run. You know, if things slow down, the economy breaks down, obviously it would fall back. But I'm just saying over a long period of time, 5 to 10 years, I think you've got to bet on inflation being higher and interest rates being higher. I think the bigger situation is going to be where you got a problem with the Federal Reserve as this problem. They are running into the problem of the U.S. government debt. Those two combined will be where you're going to have some sort of policy that addresses that, because I personally think that the long rates will go up, like, you know, you're almost at 5 today on a 30-year bond. I think they go up over this next decade, whether they lower rates or raise rates, either way. I think the average person has to realize that we've said this all year long, you need to know what you own. You know, one of the things that we have espoused really, and it paid off for us over a period of time. It hurt us during the 2021 period. We had real short maturities, so we didn't make as much money, but it helped us because we never got hurt during the rise in interest rates. You got to keep your maturities short. If you're buying 20 and 30-year paper, I think you're making a wrong bet here for the next 10 years or 20 years. That's just something that we feel like the average investor doesn't realize, but they're buying into bond funds that buy that long paper, and we just don't think that's where they should be. Well, I think it will come back to the monetary more than what we're looking at, those sorts of things, because what happens eventually is we're at this level now where debt to GDP is 120%. And so you're in a situation where foreigners own a lot of our bonds, and they're probably going to sell those bonds because with the dollar going up, that means everything they owe money in dollars is hurting them. So they've got to make some adjustments. I think that affects the rates and what I'm saying, but I think that also works itself into where everything will have more inflation as you go up. Yeah, it's going to come and go. I mean, there's no question about that. And I've said all along that if you get short-term down, and we thought you could get interest rates and inflation rates low in the short term, because things might slow down enough to do that. If that happens, don't take the bait, is what we're saying, because in our opinion, it won't last. We'll go back to normal, which should be, again, 4%, 4.25%. It should be higher than where it is now. If the forward earnings of the multiple of the S&P is 21.5 to 22, your average return over the next 5 to 10 years is only about 3 or 4%. So no, you don't have any upside. And if you think about it, and I try to mention this to people, but if you take the earnings yield, which is basically flipping, the price earnings, and it's the earnings return against the price of the S&P 500, it's lower than 90-day Treasury. So they're not paying you, what they're basically saying is the risk part of the market, the S&P, is not risky, which is not true. And so I think people have to realize if you're looking at a multiple earnings of 24's earnings, it was about 25 times, 24 and a half, or 22 times 25. I think that's where people don't realize that's well above the norm. The first time that President Trump came into office, we were barely about a 15.8 times. The upside's limited. You can see that in companies, though. We look at a lot of companies, okay? We screen, and we can always tell by the length of that list how cheap the market is. And there's not many good buys on that list right now. There's some, but on a relative basis, if you have a period like April of 2020, where we had 90% of them are good buys. See, there's a difference in which you can see it with the companies, and that's the way we look at it, really. But I'll tell you, the market's expensive. You can call it whatever. You can call it a bubble. I will tell you this. If you look at pensions, they're at an all-time high relative to their exposure to stocks. But I'm talking about going back to 1950. They're at an all-time high, something along the line of about 85%. If you look at individuals, they're an all-time high exposure to stocks. I'm talking all-time high, not just recently. And so everybody's in it. The only thing, and I feel for people particularly over 60, because they probably have too much in stocks and they don't realize it until it's too late. And then something happens and then they're in a pickle. I think that's what happens with people when you've had really good returns for a number of years without any major bear markets, which is what we've had really the last 14 years. And they just get used to things being good and they forget that, hey, I'm playing in a risky business here. I really need to know what I own. And right now they all own the same thing. They all own the index or the S&P 500, the Mag 7. Everybody's in the same thing. I call it the one button ownership because they can sell or buy on a one button click, and it's okay on the way up, but it's tough on the way down. That old saying, you go up on an escalator, but you go down on an elevator. In a bear market, everything goes down. In a serious bear market, okay, the only thing that doesn't go down is the Treasury. Now, we own a lot of Treasury, though. Let me just say, in all of our three strategies combined, we have about 50% exposure to Treasuries, all less than 24 months, by the way. So we have a high exposure to that. I've seen this over the years. They try to do various strategies that I can do this, I can do that, I can protect. But when the downside comes, it seems like there's no place to hide, unless you're short. And we don't short for people, but that would be one way to do it. But I'm just saying that liquidity is the key. If you want to have some protection, you have to have some safety or a safety valve. But you're exactly right. They all go down. Even the best stocks, the cheapest stocks now, they would get cheaper. That's okay for us, by the way, because we look at it as opportunity. I don't look as a negative, because that's when we want to be fully invested and really have a lot of exposure when things are dirt cheap. There's so many companies that are public now. Something like 8%, 9% of the really big companies and like 40% of the small companies are profitless. They're not making any money. A lot of that has to get washed out. You can't go on forever not making any money. I think of so many of the norms that people thought were norms in that 12 or 14 year period that I'm talking about are not really norms at all. That's not the way the game works. They just haven't been around long enough. And I think that's going to be the Great Reset. And the Great Reset is this. It's going to go back like it used to be. All that period there, those ultra low rates, quarter point interest rates, all that sort of stuff, easy, that's all gone. You're going to have to go back to, running a normal business. To me, that's will be the problem in the next 10 years. I have an interesting study that we have about what people think is the right amount of income and the right amount of net worth to have. Well, guess who is off the charts above any other group of people? Millennials, boomers, anybody. Z's, Gen Z. They think they should have $10 million in net worth and make $560,000 a year. There's their idea of success. But my point being is that you've got this whole group of people that have experienced really easy periods here. And so they don't know any better. We haven't had any hard times. You think about it, from 2009 until now, we had 5-week bear market in 2020. We had a 9.5-month bear market in 22. And everybody's like, it doesn't make any difference. I know, we might get some selling, but we'll go right back to a new high. Well, you might not, okay? 2000 to 2013, you know what the S&P made? Nothing. I don't know that investors are ready, particularly older investors. And I think they don't understand that they need more cash flow than what they're probably thinking about. And that's what you get in a lot of the commodity companies, pay pretty good cash flow. So you got to keep that in mind. Don't get me wrong. We're not skewed totally to commodities. When we own fertilizer companies, we own companies that do metals, but we also own a lot of growth companies. We've owned Visa and MasterCard for a long, long time. But a lot of the companies today that we wouldn't buy, we have holdovers, for example, for some Apple, but Apple, it's not really growing that much. And this company's probably done as far as the major growth they had, but they're pricing it like it's going to be a major growth company over the next 5 years, and it's priced incorrectly. Well, you know, people probably don't realize this, but gold was almost exactly the same return as the S&P 500 was. And people think about that and they think, well, if I bought gold alongside the S&P 500 in 24, we'd have made the same amount of money. And we would never buy that much gold. But I have to think that, and I've watched this with individuals, they've been selling the exchange traded funds that hold gold. They're leaving. Okay. But if you look at the foreign countries, they're buying gold and they're adding gold to their coffers. I think they're adding it because of the dollar. They don't want to be tied as much to the dollar, but they're buying it. And so I think there'll be a demand there for it. If you remember, I'll just use '08 as an example. It didn't go down until the end, but it went down, but it came back about as fast as anything did. And a lot of that goes back to, again, what do you want to own? If they get into trouble, this financing thing, I'm talking about what we've got coming due. We have so much money coming due that we've got to finance in the U.S. government, okay, that if they get into trouble and do that financing the wrong way, and we'll see what happens, gold will probably be the one thing that does hang in there. You got to remember, right now, we're in a situation where just tax receipts alone go to really pay down just the interest and a little bit of the debt. We're debted up right now, 120% of GDP, government debt. If you look at a historical graph on tariffs, they've really gone down and down and down, and they're really at the lowest point. I mean, we have some tariffs, don't get me wrong, but if you're going to come in and say, okay, across the board, we're going to do 10% or even 5%, then all of a sudden inflation's back. Okay, you know, the bond financing, all these sort of things makes things go higher in terms of inflation. And I think that's the biggest problem with it. And, you know, whether it's a negotiating tool or they really do it, I'm assuming they'll do some. But, you know, we have some interesting situations. I mean, you look at our neighbor to the south in Mexico, that's 23 or 24% imports. That's a lot. You start really moving that around. And so I hope they can think about it the right way, but who knows? Again, that's an unknown till we get into this year.